You're listening to the REITE Club podcast, where the focus is all about helping you grow your real estate investment portfolio and live the life you want to live. Come grow with us and join our community at thereiteclub.com. And now your hosts, Sarah Larby and Alfonso Salemi.
Yeah, absolutely. I mean, I think that where you invest your time, right, is what is essentially going to grow.
Yeah.
And can you share, I mean, where you were maybe in terms of portfolio size before you left and then what it looks like today?
Yeah, so I think, so when I left, I had two buildings, two multifamily buildings, a number of flips on the go, and then I had two duplexes, a fourplex, and always probably had about 3 to 5 flips on the go at once, throughout the last few years. I've recently, I can't remember what we talked about in my last podcast, but over the last year and a bit, now down to one duplex. And so this year alone, we're on track to acquire $7.6 million in apartment buildings. That was kind of the goal. The goal was 7.5, so we kind of hit 7.6 this year. And I think that's just because, one, partnering with the right people, but also just being super focused and, really focusing on the apartment building side. I mean, we get calls, emails all the time. Hey, I heard you guys are into apartment buildings. So, the branding's starting to work when people start calling you for that reason. So the apartment building portfolio has expanded to hit our goals, actually. And we thought at the beginning it was a stretch goal, and it was a bit. And, COVID, we thought was going to slow things down, and, it didn't really. And so I think it's just really because we were able to dedicate kind of all of our attention to the business that's allowed us to grow. And so we're probably on track to continue at least that pace over the next couple of years. That's what we want to do anyways.
Yeah, that's awesome. And so you're mentioning your partner and having the right people on your team. That helps as well to scale and do it successfully. So you have a business partner, and what part of the business? How do you guys split your tasks? Like, what does he do? What do you do? How are you guys have that partnership in place right now?
Yeah, for sure. So, I mean, my background, marketing and sales and such. So I deal with, I know we intersect a little bit, but there are some, pretty clear lines, I think, just because of our backgrounds and just what we enjoy doing. So I deal with, we raise capital for our projects, at least most of them. So I deal with, passive investors, the recruiting of passive investors, as well as kind of the brand building and marketing kind of components of peak multifamily, webinars, educational content and such. And then my partner will deal with a lot of the acquisition side of things. So deal flow. So we think of the business in 3 kind of buckets. There's deal flow, there's capital, so kind of sales and marketing, and then asset management or operations. So my partner Mike, he deals with the deal flow. That's what he's been really good at. He's also kind of has developed some really good relationships to keep the deals kind of flowing into us. So I deal with primarily the capital raising, and then asset management. We with property management companies on some buildings. On some buildings we do it on our own, and looking to potentially bring someone in house at this point, given the portfolio size. I think it can support that now. And so asset management, we share essentially that responsibility.
I have a question about your the type of apartment buildings that you get involved with. Do you have a favorite? Is it like a 10-plex versus a 100-unit building,
Mm-hmm.
or is there something you really like to play with and have in your portfolio or recommend to people?
So for us right now, we're on the smaller side of things. So probably the 12 to 20 is kind of where we're playing right now. The favorite for us is, so we just acquired one, or the closing is coming up in a month, but we've done our due diligence and we've gone firm. This is or close to a 20, it's an 18 unit, and it has vacancies going in, and there's opportunity to add 3 new units. So that's kind of an ideal case for us because, the whole strategy for us is the value add strategy. It's kind of like a BRRRR, but, a bigger BRRRR where the property has to lend itself to additional value opportunity. And so if we're acquiring with vacancies, we don't have to wait for turnovers. And if we're acquiring a building that has the physical structure that allows the addition of new units, then, the name of the game really is increased net operating income. So that gives us the opportunity to increase net operating income fairly quickly, kind of in the length of the project. So I would say anything that comes with vacancies and unit addition opportunities, those are kind of the, diamonds in the rough, I guess you could say.
Yeah, essentially you're going to want to pull your money that you're putting in out of the deal, and you're going to be able to do that with, like what you said, right? Increasing the NOI, or the net operating income. So how do you so two questions. How do you find these deals, or how does your partner find them? Are they on market, off market, and how? And then how are you getting them financed, being that, you're looking for the vacancies and the vacant ones?
Sure. So we get this question a lot in terms of on market, off market. So I think in the apartment building space, and I can only speak to apartment building space and nothing else, no other commercial, but apartment building space, the majority tend to be, so there's kind of quote unquote off market. It's so it really means it's not on the MLS, but it's still getting brokered by, typically getting brokered by agents that specialize in multifamily. And so they're basically exclusive listings. And those listings don't go out to everybody. They go out to, a select, group of people. Sometimes it's a large database of people, and sometimes it's only, 4 or 5 people. And the reason for that is because the sellers, as well as because the closings and the due diligence period are much longer than single family, the seller or the selling agent, they don't want to have the deal locked up for such a long period of time and then only to find out towards the end that someone's not going to close. So they're pretty selective in terms of who they send it to. So we're fortunate enough to kind of be, get sent those types of deals. I think one, because we've been able to close on deals before. So we have a track record that, within that, unit size, we'll be able to close. So source of deals is a combination of brokers that are specializing in the space. We have a deal now that we've gone direct to seller, which we were able to do. Those are great as well. We have purchased on MLS before too. So we look everywhere. At the moment, we're getting a lot of deals sent to us from agents that are listing things exclusively. So I think we've benefited from a couple things. One, just the ability to close on some deals in the recent past, as well as just the branding, the podcast, the Facebook group that we host, has helped kind of give us the credibility that, hey, we're serious. We're serious in the space. We're not fire kickers. We are, if we say we want a building, then we are going to close on it. If we're fortunate enough to get an accepted offer.
Okay, and then the second part of that was the financing piece. Is that private money? Is that VTB? Is that bank money, CMHC? How do you get the financing?
So it all depends on the deal. So this year we've done a combination of a lot of things. So we've done CMHC financing, we've done private. So it all depends on the deal. So the big thing where we spend, I'd say, most of our time, and I think where a lot of the strategic, thinking, comes to light. And this is why I say it's intellectually challenging, because we're building economic models for each building, and a deal is, at least my belief is, it's made or broken due to financing, right? So in one we just closed in July, that was, the income was high enough that we felt that it made sense to go CMHC right off the bat. So we financed a CMHC, which, the benefits to that is the amortization for that one was 40 years. So it extends the amortization for 40 years, reducing the annual and monthly financing payment. And the rate was really low. I think it was 2%, right? So I think, really good, for that building.
That's like free money, right? Like, really, it's free.
It's free money. It's pretty much free. Yeah, it's free money. It's free. We actually were this might sound a little weird. We were disappointed at 2, to be honest, because we thought it was going to come in at 1.9 or so. But
is that just for like bragging rights, being like, I got something under 2, or like, was that something in your numbers that you really wanted? No, 1.9.
Yeah, no, we underwrote the deal at 3. So we typically know if it's going to be, we're underwriting at 3. So it's a bonus regardless. So my partner, Mike, he has a building in his own portfolio. He refinanced at 1.85 a month before with CMHC. So we thought, okay, you know what, similar, we should probably get under 2. So it was because he had gotten, under 2 recently. So we thought we were going to get it. 2 still good. So that, CMHC on that one, when we acquire buildings that have very low income, it doesn't really make sense to go CMHC off the bat, because there's an opportunity within the first 12 to 24 months to increase it enough that we can then refinance at that time. So with those buildings, we would close. So I've closed with a B lender before. Now we're using kind of a private lender that's helping us. One, they're the first lender, but they're also financing some of the renovation costs as well. So that helps from just kind of a capital raising standpoint. The downside to that is that you have fairly large mortgages at a higher rate, right? So the rates that we're getting is anywhere from 6 to 8%.
Do you have properties, or when you're looking at the apartment buildings, are you assessing them based on the I don't want to say the status, but the general repair or disrepair, or the maintenance required or the renos required? Like, do you look at that a lot, or do you care? Well, we all care, but
Sure.
How much does that factor into your decision to make an offer for that building?
So I'd say the primary criteria is the delta, or the difference between what the rents are today and what they should be for that market. And so we're looking at, a good kind of quote unquote deal for us would be a building that has, rents that are probably anywhere from 40 to 60% below what it should be. And that happens for a bunch of reasons, tired landlords didn't keep up with their rental increases, or they're, upon turnover, it's quicker to get someone that's going to pay, less than kind of wait it out, right? So the primary criteria for us is the rents are much lower than what we think it should be in that market. And typically, I'd say in all cases, at least in our portfolio, it's due to, I wouldn't say poor management, but just under management or not proper management. And then those buildings all require renovations, right? So in order to get kind of the max level of rents, they do require unit upgrades. And just to standardize the process, the unit upgrades that we're doing are pretty standard across the buildings. They're anywhere from $32,000 to $40,000 per unit, and it's the same. It's basically they're identical renovations.
Thanks for listening to the REITE Club podcast and joining our community of real estate investors online at thereiteclub.com, where the focus is about helping you grow. We look forward to seeing you again next week. Thanks from your hosts, Sarah Larby and Alfonso Salemi.